This is the most critical news update we have ever released on this channel. I need you to stop looking at the price chart for a moment. I need you to stop obsessing over the red and green candles flashing on your phone screen. I need you to stop refreshing the comics feed and wondering if the price is going to $96 or dropping back to $90. Because I'm telling you right now with absolute certainty that the price on the screen is becoming irrelevant. The numbers you're looking at are ghosts. They are echoes of a system that died this morning. What matters right now, what determines whether you have wealth or whether you have nothing, whether you're solvent or whether you're bankrupt, is the infrastructure of the market itself. It is the plumbing. It is the gears. It is the unspoken agreement that allows trade to happen. And that infrastructure has officially snapped. The plumbing has burst. The gears have ground to a halt. We are declaring a liquidity freeze in the United States wholesale silver market. For 5 years, we have been warning you. We warned you about a shortage. We warned you about low inventory. We warned you about the mines running dry. But what is happening today is not a shortage. A shortage implies that the market is working. But there just isn't enough product. What is happening today is a system failure. It is a total cardiac arrest of the trading mechanism that supports the entire Western precious metals industry. We have just received the internal trade sheets from one of the major authorized purchasers for the United States Mint. Now, for those of you who do not know how this industry works, let me explain the hierarchy. At the bottom, you have the retail investors, you and me. Above us, you have the local coin shops. Above them, you have the online bullion dealers. But at the very top of the food chain, sitting right next to the government itself, are the authorized purchasers. These are the massive wholesalers. These are the companies with the billion-dollar credit lines. These are the only entities allowed to buy directly from the U.S. Mint. They are the heart of the market. They pump the silver blood into the veins of the economy. Usually, every morning at 8 O'clock, they send out a trade sheet to their network. This sheet is a menu. It lists thousands of products. It lists American Silver Eagles. It lists Canadian Maples. It lists 100 bars. And next to every product, there are two numbers: a bid price, what they will pay you, and an ask price, what they will sell to you. That sheet is the proof that the market is alive. It is the proof that liquidity exists. Today, that menu is blank. I'm looking at the sheet right now, and the status I am seeing is terrifying. On the sell side, the column that tells the dealers what they can buy for their customers, the status is uniform. It is a wall of red text: sold out, sold out, sold out. American Silver Eagles gone, not available, backorder date unknown, generic Buffalo rounds gone, 100 industrial bars gone. They're literally not accepting orders for a single physical silver product. The shelves at the wholesale level are not just empty, they have been stripped to the bare metal. If a local coin shop calls this wholesaler today and says, "I have a customer with $1 million cash who wants to buy silver," the wholesaler has to say, "I cannot help you. The metal does not exist. Shortages mean demand is high." The scary part, the part that signals a total collapse of the trading mechanism, is the buy side. Usually, if a dealer is sold out, if they are desperate for product, they will scream for inventory. They will raise their bid price. They will tell the market, "We will pay you $2 over spot. We will pay you $5 over spot. Just bring us the metal." Oh, that is how a healthy market responds to a shortage. High prices cure low supply, but not today. Today, we are witnessing an anomaly that shouldn't be mathematically possible. The status on the buy side, the price they will pay you for your silver, is no bid. Let that sink into your brain. No bid. The major wholesalers have stopped buying back metal. They have turned off the buy button. If you drove a chaotic armored truck up to their loading dock right now filled with 10,000 ounces of pristine silver bars, they would not open the gate. They would not make you an offer. They would turn you away. They would say, "We cannot buy this. We do not want it." How is this possible? How can a business be sold out, desperate for product to sell and no bid, refusing to buy product at the exact same time? It sounds like a paradox. It sounds like insanity. If you have customers waving cash at you, why wouldn't you buy the metal to sell to them? Because this is not a supply crisis anymore. This is a capital crisis. This is a liquidity death spiral. It's not that they don't want the metal. They are desperate for the metal. Their business depends on having metal. It's that they don't have the money to pay for it. The wholesalers are maxed out. Their bank accounts are frozen. Their credit lines are tapped to the absolute limit. Their cash flow has evaporated. They are sitting in empty warehouses, paralyzed, unable to restock and unable to trade. They are solvent on paper. They might have assets, but they are dead in the water because they have no liquidity. They literally cannot write the check to buy your silver. This is the moment where the market ceases to be a market. A market requires two things: a buyer and a seller. Right now in the United States wholesale sector, we have neither. We have sellers You who can't find a buyer, and we have buyers, customers who can't find a seller. The middleman, the bridge that connects the two, has collapsed into the ocean. The engine has seized up, the oil has run dry, and when the wholesale market freezes, the entire supply chain freezes with it. The local coin shop cannot restock, so they close their doors. The online dealer cannot hedge their position, so they widen their spreads to 50% or they shut down the website. The liquidity vanishes. You might be asking, how did this happen? How did the biggest, most capitalized companies in the industry run out of money during the greatest silver boom in history? Shouldn't they be rich? Shouldn't they be swimming in profits? That is the cruel irony of the financial system. The very mechanism they use to protect themselves is the mechanism that is killing them. The tool they use to ensure their business against a crash is the very weapon that is destroying them in a boom. To understand this disaster, to understand why $95 silver is a death sentence for the dealers, you have to look at the hedge. You have to look at the trap they built for themselves using the comics. We need to peel back the curtain on the dirty secret of the bullion industry. We need to explain the margin call nightmare that is currently draining every dollar of liquidity out of the United States. We need to explain why the banks are calling in their loans. Let's look at the mechanics of the collapse. Let's look at why success has become failure. You're probably sitting there scratching your head. You're probably looking at the silver price hovering near $95 and thinking, wait a minute, if these dealers have warehouses full of silver and the price just quadrupled, shouldn't they be popping champagne corks? Shouldn't they be buying islands in the Caribbean? It is a logical question. If you own an asset and that asset goes to the moon, you get rich. That is how it works for you. That is how it works for the stacker. But that is not how it works for the wholesaler. And this is the dirty secret of the bullion industry that nobody talks about. This is the mechanism that has turned the greatest bull market in history into a funeral for the very people who built the market. You have to understand that a wholesale bullion dealer is not a speculator. They are not gambling on the price of silver going up or down. They are a logistics company. They are a moving company. Their business model is simple. They buy a bar of silver for spot plus $1 and they sell it to a coin shop for spot plus $2. They make their money on the spread. They make their money on the volume. They do not care if silver is $20 or $200. They just want to move the metal. But to run a business like that, to hold $50 million of inventory in a warehouse without going bankrupt if the price drops, they have to protect themselves. They have to insure their inventory. And how do they do that? They use the comics. They use the futures market. Every time a major wholesaler buys 1,000 ounces of physical silver to put on their shelf, they immediately turn around and sell short 1,000 ounces of paper silver on the comics. Why do they do this? Because it makes them market neutral. If the price of silver drops by $10, they lose $10 on the physical bar in their vault. But they make $10 on the short position, and the two cancel each other out. They're safe. It allows them to sleep at night. It allows them to get massive loans from the banks because the bank sees that the inventory is hedged. It works beautifully in a flat market. It works beautifully in a bear market. But in a violent, vertical, explosive bull market, it is a suicide vest. Let's do the math of the disaster that is happening right now. Imagine a dealer bought 1 million ounces of silver back when the price was $25. They paid $25 million for the metal, and to hedge it, they sold short on the comics at $25. Everything is fine. The bank is happy, but then the Venezuela raid happened, then the China panic happened, then the US government buy program happened, and the price of silver rocketed to $95. Now look at the dealer's balance sheet. On the asset side, they look like geniuses. Their physical silver is now worth $95 million. They have a massive paper gain. But look at the liability side. They are short at $25. The market is at $95. They're losing $70 on every single ounce they hedged. That is a paper loss of $70 million. In theory, it still balances out. The asset covers the liability. They are still neutral. But there is one difference, one fatal difference that kills companies: cash flow. The physical silver in the warehouse does not pay you cash until you sell it. It just sits there, but the short position on the exchange does not wait. The exchange demands cash every single night. It is called a margin call. When the price goes up $1, the dealer has to wire $1 million in cash to the exchange by the next morning to keep the position open. When the price goes up $70, they have to wire $70 million cash. Not silver, not promises. Cold, hard fiat currency. Where does a dealer get $70 million in cash overnight? They don't have it in the bank. Their money is tied up in the metal, so they borrow it. They have revolving credit lines with the big bullion banks, JP Morgan, Bank of America, HSBC. These credit lines are designed to handle normal volatility. But this is not normal volatility. This is a hyperinflationary event. The price move has been so violent and so fast that it has burned through the credit lines. The dealers have borrowed every single penny the banks will lend them to pay the margin calls. They have maxed out the credit card. And now the bank has called and said, no more. The bank has said, we will not lend you another dollar. You're too leveraged. You are too risky. This is the liquidity freeze. The dealer is sitting on a mountain of silver worth hundreds of millions of dollars. They are technically rich, but they are cash poor. They are illiquid. They cannot sell the silver fast enough to raise the cash to pay the margin. And because they have maxed out their credit lines, they cannot buy new silver. If you walk in with your silver to sell to them, they need cash to pay you. But all their cash is going to the comics. All their cash is going to satisfy the margin clerk at the exchange. They literally do not have the liquidity to write you a check for $5,000. So they put up the no bid sign. They shut down the buying desk. They freeze operations. It is the ultimate irony. They bet on the dollar. They use the dollar system, the futures market, to protect themselves. And now the collapse of the dollar, which is driving the price of silver up, is destroying the dollar-based hedge that holds their business together. They are chained to a sinking ship. The physical market wants to fly, but the paper anchor is dragging them down to the bottom of the ocean. And do not think for a second that the banks will save them. The banks, JP Morgan, and the rest are the ones collecting the margin calls. They're the ones on the other side of the trade. JP Morgan is long. The dealers are short. JP Morgan is draining the dealers dry. They are taking their cash, and soon they will take their inventory. When a dealer defaults, when they can't make the margin call, the bank seizes the collateral. The bank sends trucks to the warehouse and takes the physical silver. This is a consolidation. This is a takeover. So the United States wholesale market is currently in a state of suspended animation. It is a zombie market. The lights are on, but nobody is home. The computer says sold out because if they sell the metal, they have to unwind the hedge and they don't have the cash to realize the loss. The computer says no bid because they don't have the credit to buy. It is a deadlock. And while the United States is paralyzed by this financial engineering disaster, while New York is choking on its own paper derivatives, the rest of the world is not waiting. The rest of the world does not hedge. The rest of the world deals in cash and carry. And there is one country that has smelled the blood in the water. There's one country that sees the paralysis in the West and sees it as the opportunity of the century. We need to turn our eyes to the East. We need to talk about India. Because while the US dealers are staring at their margin calls, the Indian dealers are staring at a record price of $113, and they are turning on the vacuum cleaner. Let's go to Mumbai. Let's see what a real market looks like. The center of gravity for the global silver market has violently shifted. It has moved 5,000 miles to the east. It has landed in Mumbai. And if you want to know what the real price of silver is, if you want to know what a free market looks like when the paper shackles are removed, you need to look at the multi-commodity exchange of India, the MCX. Because right now, India is not just participating in the market. India is conquering it. We have just received the closing data from the Indian trading session, and the numbers are absolutely historic. The price of silver on the MCX has just shattered every previous record. It has hit 113.88, 88 per ounce. Let me say that again so the traders in New York can hear it. $13. And that is not a premium price for a special coin. That is the wholesale benchmark price for a kilogram bar. If you convert the local currency, the rupee, at the current exchange rate, they are paying 335,521 rupees per kilogram. That is a number that would have sounded like science fiction just 6 months ago. But today, it is the reality on the ground. Now compare that to the number flashing on your American screen. Your screen says $95. India says $113. Usually silver flows from the mines in Mexico to the vaults in London and New York. That is the traditional route. But today, that route has been hijacked. Why would a refiner in Switzerland sell a bar to a New York bank for $95 when they can put it on a plane to Mumbai and sell it for $113? They wouldn't. They are capitalists. They follow the profit. The United States is being drained. The United Kingdom is being drained. We are witnessing a massive physical flight. The metal is leaving the West, where it is treated as a paper gambling chip, and it is going to the East, where it is treated as money. And the reason for this panic in India is specific. It is urgent. Rumors have been swirling in the bazaars of Delhi and Mumbai for the last 48 hours that the Indian government is about to slap a massive import tariff on silver to protect the rupee. The Indian people know their government. They know that when the government threatens a tax, they do it overnight. So the people are front or running the ban. They are panic buying. It is a stampede. Housewives are buying jewelry. Farmers are buying ankles. Businessmen are buying bars. It is not speculative buying. It is cultural buying. It is wealth preservation buying. And unlike the Americans who buy paper ETFs, the Indians buy the real thing. They take delivery. They hold it. This $18 premium is the death knell for the comics. You cannot maintain a paper price of $95 when the physical market is trading 20% higher. The arbitrage is too powerful. Traders, the smart ones who still have credit lines, are buying the cheap paper contracts in New York, demanding delivery and shipping the metal to India. They are stripping the comics to feed the MCX. This is why the wholesale market in the US is broken. The US dealers can't compete. They can't pay $113 because their customers in Ohio won't pay it. So the metal bypasses America completely. The US has become a flyover state for the global silver trade. The metal flies over New York and lands in Mumbai, and this creates a feedback loop. As the metal leaves the West, the shortage in New York gets worse. The sold-out signs we talked about in part 1 get more permanent. The no-bid liquidity crisis gets deeper because there is no metal flowing back into the system to replenish the liquidity. It is a one-way street. India buys, the West bleeds. And while the Indians are sucking the physical market dry, something extremely disturbing is happening in the paper casino that is supposed to regulate all of this. Something has changed in the behavior of the big banks on the futures exchange. For weeks, they were playing games. They were rolling their positions. They were kicking the can down the road. But on Tuesday, the music stopped. The game changed. We need to look at the comics deliveries. We need to look at the February contract because the data shows that the banks have stopped rolling and started taking. They know what India is doing, and they are preparing for the vault to empty. Let's go to the data. Let's see who is standing for delivery while the rest of the world is distracted. While the wholesale dealers are freezing and India is burning hot, the most telling signal of all is coming from the one place that usually lies to us. It is coming from the belly of the beast. It is coming from the comics futures market in New York. For the last 3 weeks, we have watched the banks play a very specific game. It is called rolling. They were taking their positions in the spot month January, and they were frantically rolling them forward to March or May. They were kicking the can down the road. They were saying, "We don't want the metal now. We will deal with it later." They were desperate to avoid delivery. They were desperate to keep the paper game going. But on Tuesday, something changed. The music stopped, the rolling stopped, and the taking began. We have just analyzed the delivery data from Tuesday's close, and the shift in behavior is undeniable. Instead of pushing contracts into the future, the banks suddenly decided to stand their ground and demand the metal now. The total deliveries for the January contract, a contract that I remind you is supposed to be a non-daily ghost town, have now exploded to 42, 65 million ounces. Now let's put that number in perspective, 42 million. In a normal January, you might see 2 million or 3 million. We are witnessing a 2,000% increase in physical demand during the quietest time of the year. This is not a trading anomaly. This is a bank run. The entities holding these contracts looked at the $18 spread in India. They looked at the sold-out signs at the US Mint, and they said, "I'm not waiting for March. Give me the bars today." And who is leading this charge? Who is the one entity that seems to know exactly when the music is going to stop? We have to look at the issues and stops report from Tuesday. There were 243 delivery notices issued. That means 243 contracts were put up for settlement. And guess who stepped in to catch them? JP Morgan. Out of 243 notices, the house account of JP Morgan stopped, which means they took possession of 176 contracts. That is 72% of the entire daily volume. JP Morgan is cleaning up the floor. They're acting like a vacuum cleaner inside the vault. Why would they do this? Why would they take massive delivery in January instead of rolling to March? Because they see the same thing we see. They see the liquidity freeze in the wholesale market. They see the Indian vacuum sucking metal out of London. They know that if they wait until March, the metal might not be there. It might be in Mumbai. It might be in a solar panel factory in Shenzhen. So they are grabbing it now. They are securing the physical asset before the system completely locks up. And the danger is not over just because January is ending. We're now looking at the February contract. February is another non-daily month. It is supposed to be empty, but the open interest, the number of contracts still open and active, is showing a potential demand for another 11 million ounces. 11 million. If those contract holders stand for delivery next week, and why wouldn't they? With India paying $113, it will break the back of the available inventory. We are looking at back-to-back months of record drain. The pause that the banks were hoping for, the breathing room they usually get in the winter, has been canceled. The drain is accelerating. This is the sign of a market that has lost faith in the future. In a healthy market, traders are happy to hold a contract for future delivery. They trust the system. In a dying market, nobody wants a promise. Everyone wants possession. The fact that rolling has stopped means that the trust has evaporated. The banks are essentially saying, I don't trust you to have this silver in March. I want it in my truck by Friday. This is the psychology of a run, and it connects perfectly to the liquidity freeze we talked about in part 1. The dealers are freezing because they are short. The banks are taking delivery because they are long. The capital is moving from the weak hands, the hedge dealers, to the strong hands, the vaults of JP Morgan and the Indians. It is a consolidation of wealth on a scale we have never seen. But here is the tragedy. Here is the cruel twist of fate that makes this situation so desperate for the American industry. The entire U.S. precious metal sector, the dealers, the wholesalers, the logistics companies, is failing not because they were wrong about silver. They are failing because they were wrong about the dollar. They tied their fate to a dying currency. They used the dollar-based system to ensure their real-world assets. And now the dollar is dragging them down into the abyss. We need to explain this systemic irony. And we need to explain why being market neutral in a hyperinflationary collapse is actually a death sentence. Let's look at the trap. And let's explain why the industry is dying while the asset is thriving. There is a cruel, dark irony sitting at the heart of this crisis. If you wrote this as a movie script, Hollywood would reject it for being too tragic. We are watching the total collapse of the United States precious metals industry, the dealers, the wholesalers, the logistics networks, and it is happening for the exact opposite reason that you would expect. Usually, when an industry fails, it is because nobody wants their product. Blockbuster failed because nobody wanted to rent DVDs. But the silver industry, they're failing because everybody wants their product. They're failing because the price of their product has skyrocketed. And the reason they are failing reveals the fundamental flaw in the entire Western financial architecture. It reveals the fatal mistake that every major dealer in America made. They tried to build a business based on sound money, gold and silver, but they built the foundation on fiat money, the dollar. You have to look at the philosophy of the hedge again. When a dealer shorts the comics to protect their inventory, what are they actually doing? Mathematically, they are betting that the dollar and silver will stay in equilibrium. They are using the paper derivative, which is a creature of the dollar system, to ensure the physical metal. They effectively tied their lifeboat to the Titanic. They thought the chain would keep them steady. They thought the chain was safety. But now the Titanic is sinking. The dollar is collapsing. And because the dollar is collapsing, the price of silver is exploding to $95. And that chain, that perfect hedge, it is dragging the lifeboat down with the ship. This is the margin call we talked about. The margin call is simply the cost of betting on the dollar. Every time the dealer has to wire cash to JP Morgan to cover their short position, they are paying a penalty for trusting the fiat system. They are bleeding capital because they refuse to just hold the metal naked. They were too scared of volatility. They were too scared of the price dropping. So they insured themselves against a drop, but they never insured themselves against a melt-up. They never insured themselves against the dollar dying. And now they are the victims of their own prudence. And there is another layer to this disaster. It is called capital intensity. Back when silver was $25 an ounce, a wholesaler with a $10 million credit line could move 400,000 ounces of metal at a time. They could run a massive business on a relatively small amount of credit. But today, with silver at $95, that same $10 million credit line only buys 100,000 ounces. Their purchasing power has collapsed by 75%. The price of the metal has gone up, but the bank's willingness to lend is not. The banks are not giving them 4 times the credit just because silver is 4 times the price. In fact, the banks are giving them less credit because they see the volatility. So the dealers are facing unprecedented finance limitations. That is the polite corporate term for we are broke. They literally cannot afford to run their business at these price levels. Silver has become too expensive for the middlemen to handle. It is like a gas station that can't afford to buy the gasoline to fill the tanks because oil hit $500 a barrel. The gas station goes out of business even though everyone needs gas. The silver dealer goes out of business even though everyone needs silver. This is why the buy button is turned off. This is why the no bid sign is up. They're suffocating from a lack of working capital. And this creates the ultimate misalignment of interests. Right now, you, the stacker, the investor, you're cheering for silver to go to $150. You want the moon, but your dealer, the guy you buy from, he is secretly praying for a crash. He is praying for silver to drop back to $50, so his margin calls stop, so his capital goes further, and so he can breathe again. The industry is at war with its own customer base. The rising price is enriching the holder, but destroying the distributor. This is the end of the just-in-time model. The model that relied on cheap credit, stable prices, and infinite paper hedging is dead. It cannot survive in a hyperinflationary environment, and as these U.S. dealers fail, as they hit their credit limits and freeze operations, they leave a vacuum. They leave a hole in the market where the supply used to be. And we know who fills that vacuum. We know who steps in when the weak hands fold. India steps in, China steps in, JP Morgan steps in. The entities with the real capital, the entities that don't need to hedge because they actually want the metal, are taking over. We are watching the transfer of the silver market from the paper hands of the Western dealers to the diamond hands of the Eastern hoarders. So where does this leave you? It leaves you standing in front of a broken machine. It leaves you holding fiat currency in a world where the people who sell real assets can no longer accept your money. The wholesale market hasn't just paused, it has died. And we need to accept the reality of the verdict. We need to summarize what happens next. Because if you think you can just wait for things to normalize, you are mistaken. This is the new normal. The freeze is permanent. Let's wrap this up. Let's look at the final verdict. So here's the verdict. We have looked at the trade sheets. We have seen the sold out signs on the sell side and the no bid signs on the buy side. We have looked at the record-breaking $113 price in India. We have looked at the internal collapse of the U.S. wholesale dealer network, which is currently suffocating under the weight of its own debt and margin calls. The diagnosis is not complicated, it is terminal. The United States physical silver market is currently in a state of cardiac arrest. The heart has stopped beating, the blood has stopped flowing. We are looking at a market that is technically open but functionally dead. You have to understand the gravity of what no bid means. It means that the liquidity, the ability to turn your asset back into cash, instantly has evaporated. It means that if you are holding silver in the United States right now, you're holding an asset that is disconnected from the local financial system. You cannot sell it to the wholesalers because they have no money. And you cannot buy it from them because they have no metal. The bridge is out. The only way to cross the river is to go where the bridge is still standing. And that bridge is in Mumbai. That bridge is in Shanghai. This brings us to the most important realization you need to make today. The price you see on your screen, the $95 trading on the comics, is now completely irrelevant. It is a zombie price. It is a price that exists only in a computer simulation, where infinite leverage and infinite paper promises still work. But in the real world, the world where you need physical metal to build a solar panel or protect your wealth, that price is a lie. The real price is $113. The real price is whatever the Indian housewife is willing to pay to secure her family's future. And the gap between the zombie price and the real price is the cost of the collapse of the Western trading infrastructure. We are witnessing the end of an era. For 50 years, New York and London dictated the price of silver to the world. They used their paper derivatives to control the physical reality. Today, that control has officially broken. The West has run out of physical metal, and now it has run out of the credit needed to pretend otherwise. The scepter has been passed. The East is now the captain of the ship. India is setting the price. China is setting the floor. And the United States is just a bystander watching its own financial plumbing explode. So what is your move? If you are holding paper, if you are holding an ETF or an unallocated pool account, you're standing in the middle of the liquidity freeze. You're holding a claim on a dealer that might be bankrupt by Friday. You're holding a promise from a system that has already defaulted on its own logistics. Get out. If you can still redeem for physical, do it. If you can't, realize that your paper position is a trap. And if you are holding physical silver, do not sell. Do not let a desperate dealer talk you into selling for $95 so they can survive another day. Do not throw your life raft to a drowning bank. Your silver is the only thing that is real. The wholesale market has died so that the true market can finally be born. The manipulation is over because the manipulators are broke. This is the reset. The sold out sign is permanent. The no bid is the silence before the scream. The Western system is finished. This is John A.G. The market is dead. Long live the price. It is over.